I mean, there's a fascinating thing which happened last week, I think on Thursday. There was a story apparently going around the Shanghai Gold Exchange and the Shanghai Futures Exchange that there was going to be a large stand for delivery in Western capital markets.
Yes.
And yeah, there was actually, as it turned out. We're talking about 36 million plus ounces of silver in a stand for delivery on COMEX. And coincidentally, the whole of the COMEX system had a data fault. Now, did they pull the plug because they couldn't resolve the situation? I mean, we're talking about a delivery of $2 billion worth of silver. Was it just coincidence that a data center had to shut down because it was overheating? No, I read somewhere by someone who is supposedly an engineering expert on cooling systems that data centers like that not only have one complete backup system, which automatically switches in if the principal one fails, but usually they have a backup to the backup. So this failure system, it's a bit fishy. So could it be that the powers that be just pulled the plug on the whole system while they tried to sort it out?
You're watching Capital Cause, and my name is Danny. It is December 1st, 2025, and my guest today, well, his name is Alistair McLeod. Alistair, thank you so much for coming on the show, my friend.
That's my pleasure, Danny.
We have so much to talk about. Let's go ahead and kick it off with the precious metals. Silver's rallying today. It's up almost $1 today. Futures price looking at $58. Gold is also up today, a little lagging behind silver, currently at $42.32. Let's go ahead and kick it off with the yellow metal, and then we'll cover the silver price thereafter. So here is a chart. Well, this is silver. Let's go ahead and take a look at gold. Gold is here. You can kind of see we made a top about a month and a half ago, and we have just been trading sideways since then. What's your prognosis on silver, Mr. McLeod?
Silver or gold? I mean, we'll talk about silver first. Silver, there's no doubt about it. There is a liquidity squeeze. And in fact, in both gold and silver, we've got this extraordinary situation with metals going into new high ground or not far off it, definitely in bull markets. And the speculative interest on the buy side, as it were, is minimal. I mean, if you look at the open interest on COMEX for gold, that's less than 420,000 contracts. I mean, that's sort of oversold level. I mean, not deep oversold, but pretty near it. And this is the fascinating thing. Gold and silver are rising without any speculative input. I mean, it's obviously a little bit, but I mean, it's tiny, if anything. I mean, it's really a squeeze on the establishment, on the paper establishment. And I think that, particularly in the case of silver, it's very difficult for the establishment actually to close out their positions. And consequently, we could be seeing, if you like, the end of the silver contract in both forward markets in London and also on COMEX. Now, that's quite a statement because so long as I've been looking at the relationship between physical and derivatives, there have been gold bugs saying the derivatives are used to suppress the price of gold, suppress the price of silver, and so on. I mean, undoubtedly that is true. But if that's coming to an end, then there is going to be massive buying pressure from that end alone. As people move out of paper, where they've got paper and they think they've got exposure to the price, as it were, they'll move out of paper and have to move into the physical. So I think we're seeing potentially momentous events. Silver could be breaking, if you like, the commodity derivative system. And that's a fascinating thought.
If it's not retail buyers taking this thing up higher, who is? Well,
this is the point, Danny. It's not buyers doing it. It's basically the shorts refusing to go even shorter. They're trying to control the position. And worse than that, they're finding the few buyers in the market are standing for delivery. I mean, there's a fascinating thing which happened last week, I think on Thursday. There was a story apparently going around the Shanghai Gold Exchange and the Shanghai Futures Exchange that there was going to be a large stand for delivery in Western capital markets.
Yes.
And yeah, there was actually, as it turned out. We're talking about 36 million plus ounces of silver in a stand for delivery on COMEX. And coincidentally, the whole of the COMEX system had a data fault. Now, did they pull the plug because they couldn't resolve the situation? I mean, we're talking about a delivery of $2 billion worth of silver. This is large. There was also a very large delivery of gold, over 58 tons on that same day. So, yeah, I mean, I think the markets are showing huge, great strain. Now, the fact that the rumor started in Shanghai rather suggests that the stand for delivery was of Chinese origin, or at least origin in that part of the world, and was known in that part of the world. I mean, I could certainly see, someone standing for delivery like that would be quite happy to talk to his chums, if you like, and say, guess what? I'm standing for delivery for $2 billion worth of silver. And I reckon that that's going to tip the market up, or whatever I say, but you can see how the rumor might start there.
Yeah. And
confirm, if you like, that it's Chinese sources who actually went for it. But the other thing that's fascinating is, was it just coincidence that a data center had to shut down because it was overheating? Now, I read somewhere by someone who is supposedly an engineering expert on cooling systems that data centers like that not only have one complete backup system, which automatically switches in if the principal one fails, but usually they have a backup to the backup. So this failure system is a bit fishy. So could it be that the powers that be just pulled the plug on the whole system while they tried to sort it out? I mean, the problem with this is that, of course, we're not just talking gold and silver. We're talking about virtually the whole of the CME shutting down, if you like, by either having the plug pulled or through a data system fault. So it's all very mysterious. It really is mysterious. I mean, what I would say is that one of the primary functions of the system, the establishment, is to ensure that if something like this goes wrong, we are not to know about it at all. They will sit on it. They will claim anything to ensure that it doesn't leak out into the public that someone is in trouble. Because if someone's in trouble, we start worrying about this, that, and the other thing. I think we're probably beginning to do that anyway when we see the stands for deliveries. I mean, I haven't actually ahead of this looked at my numbers, but I think we're looking at about 12,500 tons of silver this year, 12,500 tons of silver this year, and roughly 1,200 tons of gold. I mean, these are huge numbers. The COMEX has turned out to be the largest precious metals mine in the world by, 3-4 times the largest mining nation. I mean, this is a staggering development.
So what happened to that $2 billion order? Did it get fulfilled?
Well, no, it was a stand for delivery. Basically, someone bought the December futures. It's all on the December futures. And instead of closing the thing out and rolling it into the next one, which is normal practice, if you like, they said, right, come on, we want that stuff. Deliver, as they have the option to do. This is an extraordinary thing. It doesn't necessarily leave the CME warehouses, but the point is that the ownership changes and it goes into firm hands. It's no longer available as liquidity in the market, being registered for delivery. Comes out, that's it, tough. And in London, of course, there's no liquidity at all, which is why there's been that backwardations. And I think the reason that the backwardation has gone is principally because we're rolling over into the March contract now. So there is a time factor in there, if you like. I haven't actually done the calculation to see exactly what it sort of rather indicates in terms of, whether this is a backwardation once you allow for financing costs and all the rest of it. But, I think the point is that there are huge shortages everywhere, whether it's COMEX or London is immaterial. And incidentally, also the shortages seem to be in Shanghai, because the silver stocks have gone down. I mean, they're under 600 tons now, which is seen rather as a Rubicon figure. I mean, if you go underneath there, you got problems. It's also worth noting that from January the 1st, China is banning the export of silver. Now, that's interesting, because China has been, in my view, the swing factor in controlling prices in the West until very, very recently. So if they're withdrawing from the market completely, there is no lid on silver, none whatsoever.
Who's the kind of person or entity that would stand for deliver to the tune of $2 billion in silver?
Well, I mean, in China, it could be a speculator. I don't know. But the majority of demand, I mean, almost all the demand at the moment is actually industrial. We're seeing the gold-silver ratio drop. But the idea that, Joe Public is sort of thinking this is a cheap way into the gold story. Gold's gone. We've missed that. We've got to get into silver. It's got a big catch up. The story basically is fiat currencies are in trouble, and therefore silver will return as a monetary metal, good and proper. I don't think the public are buying that at all. I really don't, not yet. And I think that the squeeze is really the result of years of greater supply than mine demand was, could satisfy. And it's just sort of caught up with things a bit. So a lot of this move it's rather like, when you get a dislocation in the market, the price just goes crazy. We saw this with nickel on the LME, was it 18 months ago? In that case, it wasn't a shortage of nickel. There was a shortage of deliverable nickel, because the nickel had to be delivered, if you like, in accordance with what was required under the LME contract. And it was a Chinese nickel business which had loads of nickel, which it could have delivered, but not in that form. So it reneged on the contracts. And of course, the LME then had to sort of strike out any contracts that were taken out over that period. In the case of silver, it's different. It's not there. It is not there. It's gone. It's as simple as that. And of course, the other thing is that any industrial entity which has got a stockpile, is it going to let it go? In the past, it might have traded a bit, but under these circumstances, oh no, certainly not. We're going to hang on to our silver because we won't get it back if we put it into the market. So it's almost become it's a Giffen good. I've written about this a few times. A Giffen good is one which sort of upends the normal supply and demand relationship being sorted out by price. Price rises and supply increases as a result. No. What's happening is that as the price rises, the supply is diminishing. And that's having a catastrophic effect as far as industrial users are concerned. And of course, it's only just beginning to catch the attention of people in the markets who are sort of thinking, should we speculate by buying silver? Should we buy silver ETFs? I mean, we saw Indian ETFs suspend operations back in the beginning of October, because they couldn't get any metal. You could easily see the same sort of thing happening with ETFs in the West, SLV and so on and so forth. They may be forced to do that. I don't know. There's just no silver. I think that's the point, Danny.
You mentioned the ETFs. Go to take a look at that. I have SILJ up here. We're actually down today. Actually, no, we're up slightly, but we have a red candlestick here. It appears that SILJ is up 0.65%. If you look at SIL, the majors index, that's up 1.27%. The silver spot price is up 3%.
Yeah.
What does it mean? Why is the physical metal itself outperforming the more speculative names in this case? And on a side note, it's also interesting that the spot price of silver is up $1.68, while the futures price is up $1.20. So what are we able to glean any signal from that? The spot price is outperforming the futures price, the contract price, but
okay.
It's
Well,
also outperforming the indexes.
Yeah, sure. Let's take the first one. Actually, the last one you mentioned, the spot price rising more than the futures price. I think that's just showing, if you like, that the squeeze is on. The squeeze is pushing up the spot, and the futures price is either following or it'll go into backwardation, whatever. I mean, the two things aren't directly related. You're not getting the arbitrage, Danny, whereby someone sort of looks at, lease rates and all the rest of it, and premiums and things. We can trade this. They're not doing it because there isn't the liquidity to do it. Because if you're going to sell silver into, in order to do an arbitrage, whether you do it out of futures or out of London, you've got to get the stuff back. So people, I don't think, are really playing these small nuances. The one thing I've noticed when it comes to stocks, which is what SLV is, if you like, is that the price isn't necessarily tied directly to the commodity. And what we could be seeing, and I don't know that this is the case, but what we could be seeing is that the prices may be held back a little bit as authorized participants decide to borrow some stock, short it, not short it, but borrow some stock, submit that to the trustees of SLB and say, come on, we want 100,000 ounces, whatever the equivalent is. There are those games going on, which is one reason why I'm not at all keen on having ETFs. I mean, if you're an investor and you can't think otherwise, then go and play in the ETF markets. But if you come a cropper, I mean, just bear in mind, you're not buying physical metal. You're buying a piece of paper, which is a derivative of it. No more than any other derivative. I mean, if derivatives are in danger, then I would suggest that ETFs are not necessarily the best way to play this market.
Well, what about SIL and SILJ? You would think that the mining stocks would be outperforming the physical metal in this kind of scenario, but that's not. I mean, they're pretty much even here, but yeah.
I think the answer to that. I mean, I've been watching in London. We've got the largest silver mine in the world, actually, Fresnillo, listed on the London Stock Exchange, and it's been interesting to see how that performs relative to the silver price. It doesn't run ahead of the silver price. It's behind the silver price most of the time, and it maybe catches up a bit the next day. The idea that correlates quite well with the silver price. The idea that investors looking to buy or sell Fresnillo, SLB, or whatever it might be, are actually sort of bullish on silver. No, they're not. I mean, the prices are being dragged up by the physical market, not by investor interest saying, silver's the game in town, we've got to go for it, we're going to buy this one, buy that. They're not doing that. They are totally absent. And the result is that the prices are being marked up or down, more or less on yesterday's performance, if you like.
So there's a lag involved when it comes to the mining stocks.
I think there's a bit of a lag. And I mean, basically, if you are beginning to get, the price of, let's take an index of silver stocks. If they really started to move ahead of the game, then quite clearly it would be the investment community saying, silver is in a bull market. We got to buy these mines. Yeah, they're not doing that. Honestly, they're not bullish. You and I and others, if you like, who've been following gold and silver for some considerable time, could express our views by saying we're bullish of gold, we're bullish of silver. And I've just explained why the market is short, et cetera, and that's going to drive the price higher. But the investment community as a whole is just not interested. They don't understand it. They would rather chase the Nvidias and the tech stocks of this world. I mean, when we start talking mines, average investor he's clueless. He's got no idea. And he doesn't want to know, really. I mean, it's just too difficult. Just give me the things I understand, he says, I think. I think that's why you've got this sort of extraordinary situation where the response from silver mines and, encapsulated in the indices, and also for gold as well, and other mines in general, is just a complete disinterest from portfolio managers. Yeah, I mean, they've had commodities educated out of them. And apart from anything else, a commodity is not a regulated investment, and therefore it's verboten. Don't go there, mate, sort of thing.
All right, quick break here, because if you're buying gold or silver the normal way, you're probably overpaying by a lot. And that's because most retail dealers quietly tack on these huge markups, sometimes 10%, sometimes 20%, sometimes even 30%. And you don't even notice it. It's like paying $115 for a $100 bill. Doesn't make sense, right? So that's why I've been using the Bullion Standard Pro. It's a membership that basically lets you buy precious metals at real wholesale prices. The same prices that dealers get. So no inflated premiums, no middleman games. Their platform updates every 5 seconds, straight from mints and distributors. So what you see is literally the real market. And here's the crazy part. If you buy something like this gold American Eagle, here's the amount of money you're going to be saving at the time of this recording, at least. So it basically pays for itself multiple folds on many occasions, depending on what you buy. And if you want to try it out, they're hooking up my viewers with an exclusive 10% off their first month. Just use promo code COSM10 at checkout. That's COSM 10 at checkout. So if you're stacking, investing, or just tired of getting hit with hidden markups, check them out now. Bullion Standard Pro. Click on the link down below in the description box and use promo code COSM10. Now let's get back to the video. Interesting. Let's go ahead and shift over to silver. Unless there's not silver, gold. Unless there's anything else you'd like to add on top of the silver story.
Well, I think that's all you need to know. This is a squeeze on the system. China has gone out of the market completely. I mean, you can't arbitrage silver from China to sort out our markets, and that is if they were prepared to do it anyway. The squeeze is also in China. I think it's a global squeeze, and it's the result of over 5, 6, maybe 6 years of supply shortage relative to demand, and demand is just going off the scale with photovoltaic cells and all the rest of it. So silver is being driven, if you like, by industrial means. There will come a point when the investment community wakes up and decides we better have some silver. I'm not going to speculate as to what their thinking might be. But at the end of the day, you can't resist a bull market in anything. When you see something going up, you might ignore it for a bit, but then there comes a point where you can ignore it no more, and you've got to go and buy some. We have yet to see that. And it's perfectly capable of taking silver. Well, I mean, we're approaching 60 as we are. I mean, spot is 58.3. 60 is a doddle this week, easily. I mean, that's not a forecast, but I wouldn't be surprised. 70, 80, 90, 100. I mean, this is equally possible. The other thing, of course, and I'm going over to gold, which we need to move on to, is that what gold is telling us is that the whole fiat currency system is getting into deep trouble. What that means is, sorry, I interrupted you.
No, I was just going to say I have the gold chart up, but yeah, continue. Go ahead.
Yeah, I mean, the point to understand is that over long periods of time, the purchasing power of gold is stable. I mean, things change and so on and so forth, but it's been the case really going all the way back in history. I mean, the thing about gold is that the above ground stocks have tended to increase more or less in line with the global human population. I mean, we've got records that go back, quite a lot of it estimates, but, sort of, sensible estimates. And we can see that relationship. And not only that, it is embodied in all our laws that it is real money, final settlement, expunging all counterparty risk. That's the important point. And it doesn't matter what the US Treasury says, whether it's a pet rock or whatever. I mean, they're just promoting their own fiat currency instead. But the fact of the matter is that in everyone's common law, gold is money, and it is a stable form of money, and has been and will continue to be through millennia. So when we see the gold price rise from, in 1971, from $35 to currently $4,234 as we speak, I mean, that's not gold rising, that's the dollar declining. The idea that you can measure the dollar's decline by looking at consumer price index and all the rest of it, well, that gets fiddled, as we know. The best indicator that you can possibly have, not perfect, is what is the exchange rate between dollars and gold. Now, the interesting thing, Danny, is that when you look at expectations, if you like, amongst economists and also portfolio managers, they think that inflation is becoming less of a problem in 2026. They think the purchasing power of the dollar, it might drift back towards the 2% target, but basically they don't see it going up. What gold is telling us is no, that's wrong. The purchasing power of the dollar is going to decline, which put another way means the consumer price index is going to start rising, and probably quite sharply. And we can see that. Now, the reason that the consumer price index will start rising is because the purchasing power of the dollar will be declining. We are losing confidence in credit. Now, I know many economists, most economists perhaps, think that currency isn't credit, but oh yes, it is. It appears on the central bank's balance sheet as a liability. It is credit. It is the liability of the central bank. And we know that most of these central banks, including the Fed, by the way, have obligations greater than their the assets to back them in terms of value. They just don't choose not to mark things mark to market. Basically, if the Fed was a private sector industry, the directors would be in jail now because they'd be trading well bust, effectively. We know what the situation is. We can see how the debt is racking up even further. And when that happens, bond yields rise. And as bond yields rise, what happens to equities? The equity bubble goes pop.
Yep.
And when the equity bubble goes pop, then what does the Fed, what does the US Treasury do? It rescues everything it possibly can, because that is the mandate. In other words, what we're going to see, what gold is telling us, is that the conditions that are evolving now are guaranteed to lead to the debasement of the currency, of the fiat currency, big time. So everybody's expectations that inflation is not going to be a problem in 2026 is so far wide of the mark. And I don't know of anyone who's looking at inflation in 2026 and saying, this is going to rise and rise and rise. But that is what the outcome is. That is what gold is now telling us.
Here's the Japanese 10-year yield, up 4.3% today.
Yeah.
Check out that green candlestick. I mean, that is a massive jump. I mean, aside from about a month ago.
Way back. Yeah.
But regardless, I mean, you look at this chart.
Yeah.
I mean, this is a massive move to the upside.
Yep.
Bond yields are spiking. I mean, you alluded to this just a second ago that this would precipitate a stock market crash.
Yeah.
And now you're starting to see crypto, start to crash as well. Is this all connected? Is this all connected, Alistair?
Everything is connected. Everything is connected. I mean, thank you very much for reminding me about the JGB yields. Yeah, I mean, the point about the Japanese bond market, and if you look at the 2-year rate, I think you'll see that's yielding more than 2% now. This is destroying the carry trade.
Got it.
I don't know if you can get it up. The 2-year JGB.
I'll search for it, but in the meantime, if you don't mind, just
yeah. Well, basically, the carry trade is now having to unwind. It's no longer profitable.
Here it is.
Yeah, there you go. What's that yield? I can't quite see.
1.02%.
1.02. Okay, you're right. Okay, 1.02%. The problem is that if you're a hedge fund,
just really quick, up 5.4% today. Look at the distance between the previous day and today.
Up,
massive distance.
Up. Yeah, big time, isn't it? Look at that. Yeah.
Mm-hmm.
I mean, the point is that the carry trade is now a loser. And you got what? I mean, there could be 10, 20 trillion, if you like, of funding using the carry trade to do various things, but principally finance the US Treasury. This is concerning. I mean, we've seen, for example, just about the largest holders of US Treasuries are now unknown entities in the Cayman Islands. These are offshore hedge funds, which along with Luxembourg, which basically has set up special purpose vehicles to get euros in, which yield, a lot less than US treasuries, package them up and then go and buy US treasuries. I mean, this sort of hedge fund recycling, if you like, through the carry trade is enormous. And I think the degree to which the US Treasury is depending on this to finance its deficit and to refinance maturing debt, this is leading into something which I think could rapidly escalate into a problem. And it's no wonder that the Fed has withdrawn from quantitative tightening, because it's seen this. I think it's seen this coming. And it's going to reintroduce QE yields.
Are they going to monetize the debt to try to bring down the interest rate?
Well, exactly. I mean, they won't I don't think they'll manage to bring down the interest rate much, but it'll take a bit of pressure off the bond markets because they've got to absorb what nobody's buying. This is the problem. So, it's monetizing the debt. I mean, that's going on, and it's going to accelerate. But where does that leave the equity bubble? I mean, this is the fascinating thing. And then, of course, we've also got, as you said, Bitcoin. Now, Bitcoin, I've been telling everybody who will listen that this is symptomatic, if you like, of the top of any credit bubble. I mean, we had, in the 17th century, we had the tulipomania. Bitcoin's like that without the bulbs. I mean, that's all it is. I mean, the idea that it's money, no way. I mean, okay, you can always get consenting adults who'll say, all right, I'll take some Bitcoin in return for this. But there's the idea that it will circulate as money in any sense is complete rubbish. It's a system which is full of crooks. Money launderers have been using Bitcoin and similar things, but principally Bitcoin, as a vehicle for money laundering for a long time. And I mean, this is something which, when it goes, it's just going to implode. And we're talking about ordinary people losing huge amounts. I mean, we're looking huge amounts. We're talking about over $1 trillion. Bitcoin are worthless. It's just it's just an ephemeral idea. So the fact that it's now beginning to collapse, along with tech stocks looking pretty rocky, with which it has been correlating quite nicely, you can see that this is showing that the whole thing is very, very close to the equity bubble bursting, the credit bubble bursting. And look at the margin debt recorded by FINRA. I mean, that in the last 10 years has gone from 300 billion, it's currently 1.2 trillion. That's margin debt. And I mean, that's probably supporting long positions worth 3 trillion plus. I mean, that would be the sort of relationship. And that doesn't include credit, if you like, given to hedge funds and all the rest of it. There's really big guys who go direct to the banks. They don't go through brokers to borrow. They go direct to the banks. There is a lot of hot air in these equity markets, which is going to make 1929 look like a Vickers Tea Party, in my view.
Yeah, here's your margin debt statistic. Yeah, the blue bars are your margin debt, and they have been just going sky high. The red line is your S&P index, and they have pretty much been moving in tandem.
That's why I love doing this with you, Danny. You managed to get up the the charts in a way no one else does.
Oh, thank you.
That's a brilliant one. That really is. Yep. There you go. And it actually correlates the whole way along, doesn't it? Very, very nicely.
Pretty much. Yeah. So you can make the argument that the S&P is, in some sense, a function of margin debt.
It is precisely that. Exactly. I mean, it's precisely a function of the credit going into the market. I mean, the idea that it's it's driven by value or momentum or whatever is actually wrong. Just look at the credit. Just look at the availability of credit to drive prices higher. That's what's happened.
For sure. So, I mean, I think we've covered pretty much the waterfront here. Anything else you'd like to cover, Alistair, before we take this thing home?
Well, I think the sort of the end conclusion of my view on the whole thing is actually extremely concerning. Because what we are seeing with debt to GDPs and the G7, typically 100% or more, is we're seeing the end of the fiat currency system. But what that means is that until we find a better way forward, sort of go back to gold standards or whatever, whatever they come up with, something to stabilize the system, then the value of these currencies in terms of their purchasing power in 2026 and into 2027 is going to collapse. It's going to go down and down and down. So what we're going to see, I mean, put gold and silver to one side. They're just saying that this is going to happen. Let's just look at what is going to happen. And that is things like food prices are going to become completely unaffordable for those who rely on government handouts. You look at commodity prices as a whole, the whole of that complex is going up. It's going to drive up the prices of consumer goods, the whole thing. That, I'm afraid, is what we are going to see. And the most instructive preparation you can make for this is to examine what happened in Germany between 1922 in particular, or end of 21, and 23. At the end of 21, a stock market boom, which tripled the index, the German share index at that time, came to an end with a crash on December the 1st, 1921. And then inflation really took off. What happened was that the index only fell in nominal terms by something like 25%. But measured in gold, it lost 93% of its value in a matter of weeks.
Wow. That's
what happens when an equity bubble bursts and where the government is working on a fiat currency system and has no option but to step in and rescue the banking system, the economy, all those zombie companies and all the rest of it, try and keep value, if you like, in financial assets, value and credit, by basically swamping things with fresh currency. And that's going to happen. That's what we see. That's what I see. That's the implication of everything that I've been talking about. I hope it doesn't happen, but we've got to start thinking really quite seriously about this possibility.
Well, they've already started putting silver and uranium and all of these other key metals into the critical minerals list here in the United States government. And then you also gave me an interesting idea. You mentioned that food prices are going to become unobtainable for welfare holders and things like that.
Unaffordable.
Unaffordable. Yeah. Sorry, it'll be obtainable, but unaffordable. I'm thinking of Sylvia here, so I've got the two mixed up. But you look back at the government shutdown, and you look back at this episode of the food stamp holders not getting their food stamp benefits. It kind of makes you wonder: was that a test run, or could that be viewed as a test run at the very bare minimum of things to come to kind of gauge public sentiment?
No, I don't think so. I mean, there is this tendency to think that people in government know what they're doing. I got very bad news for everybody. They haven't a clue. They stagger from one problem to the next one. And no government actually has the time to sit back and think, what happens if? Is this a danger? There's none of that reflection at all. And in the case of, both America and also the UK, governments are not in charge. Their permanent civil servants are in charge. They actually make the policy. And in our case, the cabinet just endorses it. The cabinet carries the can for the civil services mess. That's where we are. And of course, in America, I mean, you've got exactly the same thing. I mean, effectively, you've got the deep state. And if you look at the people behind Trump, I mean, have they changed very much from the Biden days? Well, yeah, a bit. But I see Marco Rubio still in there, that warmonger. And we're now talking. I mean, this, talking about the stupidity of governments. We now have Starmer, Merz, and Macron getting together to wage war against Russia. I kid you not. That is where they are going with this.
And they've opened up voluntary. No, I was going to say they've opened a voluntary service for 18 and 19-year-olds in France as of recently.
Yeah. No, absolutely.
That's the first step.
But it's the step to look at is that the three big leaders in Europe, two of them in the EU, are getting together and they're planning to wage war against Russia. They've got it into their heads that they need to do this because otherwise Russia will wage war on them. It's not the case at all. Russia is trying to get NATO out of Ukraine. That's principally what they want. And Russia has said this. And if you also listen to people who actually understand these things, like Jeffrey Sachs and John Mearsheimer, you can see the whole history has been laid out for us. We provoked this. I mean, Victoria Nuland at the time of the Orange Revolution, all the rest of it, what was it all about? This was a proxy war whereby America in particular, backed up by NATO, who basically America's poodled, will dismantle Russia. That's the objective. And of course, it's gone wrong. So President Trump comes in and thinks he can sort it out. Well, good luck with that one. This will be sorted out on the battlefield. Meanwhile, you have what Escobar calls European chihuahuas, or these sort of European dogs who think that they are absolutely enormous and very powerful, but actually they are tiny little chihuahuas yapping furiously. Bloody ineffective, but they're trying to drag us all into a war against Russia.
Because it's
unreal.
It's their neck on the line. It's their neck on the line. If they don't divert the attention away from their failing policies, be they economic, monetary, and otherwise, they're going to be the ones facing the fire. So in order to avoid that, they've got to take us to fight their war for them.
Yeah, I don't disagree with that at all. And there's not enough evidence around to say that your analysis there is absolutely 100% correct. But the fact of the matter is that the idea that governments know what the hell they're doing, which was how we started on this tack, is just completely absent. And why do we continue to be fooled that governments know better than us? No, they don't. They've got no idea. They're bloody well clueless. And this is dangerous. And it's this danger which is now becoming evident, if you like, in the gold price. Because the gold price is saying your currencies are going down the toilet. That's what it's saying. So there we go.
Are you planning to stick around in the UK or eventually getting out?
Let me put it this way. If I wasn't happily married and I didn't have any family, I would probably be with a cousin of mine in the Caribbean who has a very nice island life there. We've got the communications. We can do all that sort of stuff. Or I could go to somewhere where there is no taxes. I don't mind contributing to a community, a nice island community. I would love to do that.
Mhm.
But the reality is, and I'm sure you're in the same position, Danny. The reality is that we have connections, we have family, we have friends, we have people who either rely on us, but we think probably will have to rely on us somewhere down the road when all this goes wrong. And you can't walk away from these responsibilities. You really cannot.
I agree. Well, Alistair, thank you so much for coming on, my friend. Guys, if you enjoyed this podcast, be sure to drop us a like and subscribe to the channel. It really does help in boosting us in the algorithm. Alistair, where can people find you if they want to see more of your work?
McLeodfinance.com.
Excellent.
Quite simple, but no. And thank you very much for having me on.
Yeah, we'll have the links to your Substack down below. I highly recommend you guys check it out. And then we'll also... I want to encourage you to hit that like and subscribe button. Again, it does help in pushing us in the algorithm. And check us out on Substack as well, capitalcosm.substack.com, to get access to all of my interviews early and ad-free. And with all that said, I appreciate your time, guys, and I will catch you next time. Bye.